Rho is a Greek letter that is used to measure the sensitivity of an option's price to changes in the interest rate of the underlying asset. It is one of the Greeks that options traders use to assess the risk and potential return of an option position. Along with delta, gamma, and theta, Rho is an important concept for options traders to understand because it can impact the pricing of options and the profitability and risk of a trade. In this article, we will delve deeper into what Rho is, how it is calculated, and how options traders can use it to their advantage. What is Rho? Rho is a Greek letter used to represent the sensitivity of an option's price to changes in the interest rate of the underlying asset. It is expressed as a percentage and represents the amount by which an option's price is expected to change for every 1% change in the interest rate. For example, if an option has a Rho of 0.1, it means that for every 1% increase in the interest rate, the price of the option is expected to increase by 10 cents. It should be noted that Rho is most relevant for options on interest rate assets, such as bonds, however can also be applied to other assets. Rho is generally considered to be a less important Greek compared to others such as delta, gamma, and theta, as changes in interest rates tend to have a smaller impact on the price of options compared to changes in the price of the underlying asset or volatility. However, it can still play an important role in the pricing of options, especially in the case of interest rate-sensitive assets such as bonds. For call options, a positive Rho value indicates that the option's price will increase as interest rates rise. This is because a higher interest rate means that the option holder will have to pay more to borrow money to exercise the option and purchase the underlying asset. On the other hand, for put options, a positive Rho value indicates that the option's price will decrease as interest rates rise. This is because a higher interest rate means that the option holder will receive more income from holding the option. How is Rho calculated? The calculation of Rho involves the use of complex mathematical formulas and computer simulations. It is based on the Black-Scholes model, which is a widely used model for pricing options. The model takes into account various factors such as the current price of the underlying asset, the strike price, the time to expiration, the volatility of the underlying asset, and the interest rate. By plugging in these values and solving the mathematical formulas, the model can calculate the Rho of an option. It is worth noting that the Black-Scholes model is a theoretical model, and actual option prices can differ from the model's predictions. Factors such as transaction costs, liquidity, and taxes can affect the actual prices of options and so, should be considered when evaluating the validity of the Rho. How options traders can use Rho to their advantage. Options traders can use Rho to their advantage in a number of ways. For example, a trader who is bullish on a stock but is concerned about the potential impact of rising interest rates on the value of their core options can sell a put option to offset the negative Rho of the call option. This strategy, known as a bull-put spread, can help to reduce the overall risk of the position and potentially increase profits. Another way options traders can use Rho to their advantage is by using it to predict changes in the interest rate. If a trader believes that interest rates will rise in the future, they can buy call options with a positive Rho value. If the interest rates do rise, this will cause the price of the call options to increase, resulting in a profit for the trader. Similarly, if a trader believes that interest rates will fall in the future, they can buy put options with a positive Rho value. If the interest rates do fall, this will cause the price of the put options to increase, resulting in a profit for the trader. Options traders can also use Rho as part of a hedging strategy. For example, if a trader holds a bond portfolio and is concerned about the potential impact of rising interest rates on the value of their bonds, they can buy put options on interest rates as a hedge. This can help to offset any potential losses in the bond portfolio if interest rates do rise. Another strategy that can be used is called Rho neutralization, where the trader can go long a call and short a put on the same underlying stock, with a strike price that is close to at the money, and similar expiration date. This will help reduce the Rho impact of the position and make the trade less sensitive to interest rate moves. It is worth noting that when using Rho as a strategy, it should be considered along with other Greeks such as delta, gamma, and theta to get a better understanding of the overall risk and potential return of an options position. Additionally, it is important to keep in mind that option prices are influenced by multiple factors, Rho being just one of them. Trading decisions should be based on a variety of inputs and not just on a single metric. In conclusion, Rho is an important concept for options traders to understand because it can impact the pricing of options and the profitability and risk of a trade. While it is considered a less important Greek compared to others like delta, gamma, and theta, it can still play an important role in the pricing of options, especially in the case of interest rate-sensitive assets such as bonds. By understanding Rho and how it impacts your options trading, you can make more informed investment decisions and potentially improve your profitability. If you enjoy our content, don't forget to like the video and subscribe to stay up to date with market news. Thanks for watching, and stay informed.